Right now, Rezolve AI PLC, ticker RZLV, is trading live on the NASDAQ at $4.24 a share, down about 2.1% on the session so far. It has been oscillating in a fairly tight range today, between $4.09 on the low end and $4.35 on the high side, all on significant volume of over 5.7 million shares. And the first thing you are probably thinking when you see that price is that this is a stock under pressure, a company that is struggling. The narrative you might have picked up from forums or social media is one of lawsuits, cash burn, and a stock that has fallen hard from its 52-week highs. The general expectation for many is that this is a name to avoid, perhaps even a short seller's target. But what if I told you that while you are looking at that $4.24 price, Wall Street analysts are, almost in unison, looking at an average price target of $10.79? What if I told you that in the last reporting quarter, institutions like BlackRock and Vanguard didn't just buy a few shares, they increased their total ownership position in the company by more than 400%? Suddenly, the reality of what is happening under the hood of RZLV looks profoundly different from the expectations set by its current share price. This is one of the most polarized stocks on the market, a genuine battleground where the story of its future is being fought in real time. Let's establish what everyone seems to be worried about, the common ground for the bearish case. This stock has been volatile, and that volatility has been fueled by online discussions, particularly on platforms like Reddit, focusing on two significant lawsuits filed against the company by Yorkville and JBAAM. These legal actions stem from a proposed $1 billion Bitcoin financing arrangement back in February that ultimately never closed. The plaintiffs are reportedly seeking substantial damages in the hundreds of millions, arguing the company didn't meet its obligations. For many individual investors, this is a massive red flag. It creates an overhang, a cloud of uncertainty. When you combine this legal drama with the fact that Rezolve is, like many high-growth tech firms, unprofitable on a net income basis, you get a simple and scary story: a cash-burning company with legal troubles. This is the narrative that has many convinced the stock is heading to $3 or even $2 a share, and it's a narrative that some are actively shorting. But this is where we have to separate the noise from the numbers, because the fundamental reality reported by the company just a few weeks ago, on October 1st, paints an entirely different picture. Rezolve announced its first half 2025 results, and they didn't just beat expectations, they shattered them. Revenue for the first half came in at $6.3 million, a staggering 426% year-over-year, and comfortably ahead of the $5.1 million consensus. But the number that should make any serious investor stop and read twice is the gross margin, 95.8%. That is not a typo. 95% gross margins, completely blowing away analyst forecasts that were in the 60 to 70% range. This indicates that their core AI-powered commerce product is incredibly scalable and profitable on a per-unit basis. The company did report an adjusted EBITDA loss of $17.7 million, but even this was a beat, as analysts were expecting a worse loss of $18.7 million. More importantly, the company is not in a precarious cash position. Following two financing rounds in the third quarter that raised $250 million, Rezolve ended September with approximately $230 million in cash on its balance sheet. This isn't a company about to go bankrupt tomorrow. It is a company that has just funded its growth plans. And those plans are ambitious. Management didn't just reiterate guidance, they massively raised it. They now project exiting 2025 with an annual recurring revenue, or ARR, rate of $150 million. They also initiated guidance for 2026, projecting a $500 million ARR exit rate. This is the reality that the institutions are looking at. They see a company with 100-plus enterprise customers, including giants like H&M, Ferrero, and Urban Outfitters, partnerships with Microsoft and Google, and a clear, funded path to explosive revenue growth. This brings us to the professionals, the ones that do this for a living. The institutional 13F filings from the last quarter are, frankly, stunning. The number of funds reporting a position in RZLV jumped by over 117% to more than 100. The total number of shares held by these institutions surged by over 440% to 13.6 million. We are not talking about small, unknown funds. The new shareholder list includes BlackRock, Geode Capital Management, Northern Trust, State Street, and the Vanguard Group. This is the definition of smart money piling in. At the same time, Wall Street analysts are racing to keep up. Just yesterday, Fintel reported the consensus one-year price target had been revised upwards by over 36% to $10.79. Firms like Cantor Fitzgerald, Roth Capital, and H.C. Wainwright have all reiterated their buy or overweight ratings in the wake of that earnings report. So we have a $4 stock that the pros believe is worth more than $10. We have retail traders screaming fraud while BlackRock is buying millions of shares. This is the tension that defines RZLV. Now let's look at this through the lens of the short sellers, because this is where the story gets even more complex. The official short interest, according to NASDAQ data, is about 11.55 million shares. That's about 7.7% of the float. It is a significant number, representing a substantial bet against the company. This is the data the bears will point to. But you have to look deeper. The first thing an investor should do when they see high short interest is check the days to cover. For RZLV, that number is just 1.08 days. Because the stock trades with such high volume, like today's 5.7 million shares, it would take the shorts just over 1 day to buy back all their shares and close their positions. This is not the setup for a massive technical short squeeze. The liquidity is too high. A squeeze is off the table. This is a fundamental war. Here is the most telling clue: the short borrow fee rate. This is the interest rate short sellers must pay to borrow shares. When demand to short a stock is high, this rate spikes. But for RZLV, the opposite has been happening. Fintel data shows the borrow weight was near 20% back on October 16th. As of October 27th, it had fallen to around 12%. What does this mean? It suggests that the demand to initiate new short positions is weakening. It is possible that the shorts that were in place before the October 1st earnings report are now quietly covering, taking their profits or cutting their losses, and getting out of the way of the new institutional wave. The high off-exchange short volume ratios we have seen, often more than 30% and sometimes much higher, also tell a story. This indicates that large professional short trades are happening in dark pools, not on the open market, trying to avoid moving the price. What's your take on this short interest data? Do you think the falling borrow rate signals the shorts are retreating, or are they just reloading? Comment below. For an investor trying to navigate this, here are the actionable steps. First, you must get your data from primary sources. Go to your brokerage platform or a reliable financial data provider and look up the official short interest data yourself. Don't rely on a tweet or a forum post. Second, monitor that borrow fee rate. If it starts to spike aggressively, it means demand to short is returning. If it continues to fall, it confirms the thesis that shorts are losing their conviction. Third, look at the options market. The current put-call ratio for RZLV is a very low 0.16. This is incredibly bullish. It means far more call options, bets the stock will rise, are being traded than put options, bets the stock will fall. This is another data point that contradicts the bearish social media narrative. You have to ask yourself, are you betting with the retail traders citing old lawsuits, Or are you betting with the institutional money and the options that are both looking at the 426% revenue growth? So what does Rezolve AI PLC actually do to justify this? It's not just a concept. The company provides what it calls AI-powered commerce solutions. Its BrainSuite platform is essentially an intelligent layer that sits on top of a retailer's existing app or website. It uses conversational AI and intelligent automation to change how you shop. Instead of just typing in a search, you could theoretically ask your phone to find me a blue dress for under $100 that I can pick up today. And it would interact with the store's inventory, your location, and payment systems to make it happen. They're also building out agent-gentic commerce, where AI agents can conduct entire transactions on a user's behalf. This is the technology that has attracted partners like Microsoft and Google, and customers like H&M.